Welcome to the deep dive. Today we're digging into an article from the Motley Fool. It's looking at boosting passive income, specifically through one company, Energy Transfer, ticker's ET.
Right. And they frame it as a high-yield master limited partnership, an MLP.
Exactly. So we're looking at this financial analysis, this specific investment idea.
Yeah, focus on the income side of things.
And for you, the learner, the mission here is really to figure out, okay, could something like Energy Transfer, these high-yield dividend stocks, actually be a good way to, ramp up passive income?
And what are the catches? What do you really need to think about?
Right. Because the hook is pretty strong. The article says for every $1,000 you put in, you might get about $75 a year in income.
Which, when you compare up to the S&P 500 average,
Wow.
that's way higher.
Yeah, the S&P gives you maybe $15 for that same 1,000. So, okay, let's start basic. Dividend income. What are we actually talking about here?
Well, basically, it's companies sharing their profits with shareholders. You own stock, the company does well. It might pay you a slice of those earnings.
Simple.
And the amount depends on how many shares you have, obviously, and what they decide to pay per share. The article uses that S&P 500 average yield around 1.5% as a benchmark.
Okay, so that 1.5% helps you see just how high Energy Transfer's yield is supposed to be.
Exactly. Puts it in perspective.
So who is Energy Transfer then? The article calls them one of the biggest energy midstream companies in the U.S. What's midstream?
Okay. So think of energy having three parts, right? Upstream is finding and drilling it. Downstream is like gas stations and refining. Midstream is the bit in the middle.
The transport bit.
Yeah, exactly. Transportation, processing, storage. Energy Transfer owns a huge network of pipelines for oil and gas, processing plants, storage terminals, even places to ship it overseas.
Okay.
They're basically the highways and hubs for energy moving across the country.
Got it. So pretty essential infrastructure sounds like. Now, the stability aspect. The article stresses their income is stable. How come?
Yeah, that's a key point. About 90% of their earnings, roughly, come from fees. It's not just about the price of oil or gas going up and down.
How does that work?
Well, a lot of it is based on long-term contracts where customers pay a set fee to use their pipelines or facilities, or sometimes rates are regulated by the government.
Okay. So it's more like a toll road for energy. They get paid for volume moving through.
That's a good way to put it, yeah. It makes their cash flow pretty predictable, less volatile than, say, an oil producer.
And they generate a lot of cash flow. The article mentioned, $8.4 billion last year?
That's right, a really substantial number. And they paid out about $4.4 billion of that to investors.
Okay, so what about the rest? The other $4 billion?
Well, that's what's interesting. They kept it, used it for expansion projects, paying down debt, basically strengthening the company financially.
Which sounds healthy, not just paying out everything they make.
Exactly. It suggests they're thinking about the long term, maintaining that strong balance sheet.
Right, okay, so the payout itself, it's currently 0.325 cents per unit each quarter.
Which works out to $1.33 per year. And based on the price when the article is written, that's where you get that roughly 7.5% yield.
But it's not just sitting there, is it? They plan to increase it.
Correct. The company's stated goal is somewhere between 3% and 5% growth in that payout each year.
And are they doing it?
Well, over the past year, they increased it 3.2%. So, yeah, they're pretty much in line with that goal. The article points out the typical quarterly bump is tiny, like 0.00255 per unit.
Which is a penny a year.
Right. But it adds up. It shows that steady, kind of gradual increase in the income stream.
So high yield now, plus potential for it to grow a bit each year. That's definitely part of the appeal. What about fueling that growth? Where does the money come from for future increases?
Good question. Two main ways, really. First is internal growth, building new stuff. They're putting serious money into expanding their system because, demand for oil and gas is still projected to grow. They spent $3 billion last year.
Wow.
And they're planning on spending $5 billion this year.
On what kind of projects?
Things like a major new natural gas pipeline, more gas processing plants, expanding their ability to export energy, big infrastructure projects.
And these aren't like 10-year plans. They're coming soon.
Yeah. The analysis says these projects should start adding to cash flow, between now and the end of next year.
Okay, so fairly near-term impact.
Plus, they're working on this big Lake Charles LNG export facility. And the article even mentions they're looking at how to support natural gas demand from, AI data centers.
Interesting angle. So they're adapting.
Seems like it. They're actively investing, not just coasting.
Okay, so that's internal growth. What was the other way?
Acquisitions. Buying other company?
Right. The article called them accretive acquisitions. What's that mean in simple terms?
Accretive just means the deal is expected to boost their earnings, or in this case, cash flow per unit, make each share more profitable.
Gotcha.
And they gave the example of buying WTG Midstream last year. Cost over $3 billion.
And the impact?
The analysis estimates that one deal could add about $0.04 per unit to cash flow this year, and maybe $0.07 by 2027.
Just from that one purchase?
Yeah. The suggestion is that acquisition alone could pretty much cover their distribution growth target for a few years.
Okay, so buying growth can work too, and they have the financial strength to do more deals if they want.
That's the idea. Strong balance sheet gives them flexibility. So, yeah, multiple ways they could potentially keep that dividend growing.
All right. Sounds pretty positive. But there's always a but, isn't there? The K-1 tax form.
Ah, yes, the K-1. This is definitely something potential investors need to know about with MLPs like energy transfer.
It's different from the usual 1099 form you get for stock dividends.
Very different. A standard company sends a 1099 DIV. Simple. An MLP, because it's a partnership, sends you a Schedule K-1.
And that's more complicated.
It can be, yeah. It reports your share of the partnership's income, deductions, credits, all sorts of stuff. It often arrives later in tax season, too. And sometimes, depending on where the MLP operates, you might technically need to file state tax returns in multiple states, though tax software often handles some of that now. It just adds a layer of complexity to doing your taxes.
So more paperwork, maybe need special software, or even an accountant.
Potentially, yeah. It's definitely not as straightforward as a 1099. But
there's an upside. The article mentioned potential tax advantages.
That's the flip side. While it's more complex, MLPs can offer tax benefits. A big one is tax deferral.
Meaning?
Meaning a chunk of the cash distribution you get might be classified as return of capital, not immediate income. You generally don't pay tax on that portion until you sell your units.
Ah, okay, so defer the tax burden.
Potentially, yes. So the K-1 adds hassle, but it could also lead to paying less tax now on the income received. It's a trade-off. You really need to understand how it impacts your specific tax situation.
Definitely something to weigh up. Okay, let's try and pull this all together. The big takeaway seems to be Energy Transfer offers a much, much higher dividend yield, that 7.5% number, than your average stock.
For sure. That $75 per $1,000 versus $15 really highlights the potential boost to passive income.
And the analysis suggests this yield isn't just smoke and mirrors. It's backed by pretty stable cash flows from their pipelines and stuff.
Right, that fee-based model.
They're not paying out all their cash, they're reinvesting.
Well, sensible payout ratio, yeah.
And they have actual plans for growth, both building things and buying things.
Organic growth and acquisitions, all factors that could support keeping that dividend going, maybe even growing it.
But for some, you've got that K-1 tax form complexity to deal with.
Absolutely. It's not a deal breaker for everyone, but you have to be aware of it and comfortable with it. It's part of the package with many MLPs.
So the final thought for you, the learner, is really about that trade-off. Considering that potential for significantly higher income, how much tax complexity are you willing to handle? And bigger picture, how does an investment like this, tied to the energy sector, fit with your own financial goals and maybe your view on where energy is heading?
Lots to think about there.
Indeed. Thanks for taking this deep dive with us.